All right, welcome to this explainer. Today, we're diving straight into a massive, honestly pretty painful beginner mistake that ends up costing retail investors dearly. Look, if you've ever opened up platforms like Grow, Zeroda, or TickerTape and made a split-second judgment based on just one basic metric, well, you're definitely going to want to pay close attention. We are literally tearing down the illusion of the cheap stock today, and we're specifically putting the infamous price-to-earnings, or PE, ratio under the microscope.
So picture this. You're casually scrolling through your investing app, running a few screens, and bam, you see a stock priced at exactly 100 rupees. For so many of us, our brains immediately short-circuit to, wow, I found a cheap bargain. It just feels so accessible, right? It feels like you could scoop up a massive chunk of shares without totally breaking the bank.
But hang on a second, because that reaction sets up our entire journey today. Is that $100 stock actually cheap? Because here's the absolute, undeniable truth about the markets. Share price alone does not equal valuation. Not even close. And what's even more dangerous is that a low headline PE ratio, sitting right next to that $100 price tag, will completely trick you if you don't look under the hood. Remember, a PE ratio only tells you the price relative to one single year of earnings. It doesn't tell you the whole story. So, to avoid falling into this value trap, we're going to apply a strict three-part framework today. First, earnings quality. Second, growth versus price. And third, balance sheet risk.
Okay, let's jump straight into pillar number one, earnings quality. Since PE is literally just price divided by earnings, we desperately need to know if that E is actually trustworthy.
Now look at the stark contrast here. You absolutely cannot just blindly trust the headline reported PAT, or profit after tax. Why? Well, in the accounting world, paper profits can sometimes be, let's say, influenced by non-cash items. It's kind of like smoke and mirrors. You must compare that reported PAT against the actual cash from operations. Essentially, what you're asking is this paper profit actually translating into cold, hard cash in the company's bank account? A much healthier signal is when you see the earnings trend roughly tracking operating cash over a solid 3 to 5 year period.
And you don't have to guess where to find this stuff. You can verify these numbers yourself in annual reports or right on platforms like screener.in. What you're really trying to sniff out are one-time items. Did the earnings jump because they actually sold more of their core product? Or did they just sell off a massive piece of prime real estate? Or maybe get a one-time tax credit? If a stock looks miraculously cheap today, it might just be because last year's profit was a total one-off spike. When that profit inevitably drops back to normal next year, that supposedly cheap PE is going to absolutely skyrocket. So always prefer a 3 to 5 year average, especially for cyclical companies, just to make sure you aren't buying in right before a massive mean reversion.
All right, assuming those earnings are actually real, let's move to our second mandatory check, growth versus price.
Now we're shifting from looking backward to looking forward. And this brings us to a fantastic, informal little tool, the PEG ratio. It's basically the PE ratio divided by the expected earnings growth rate. Think of it as a quick sanity check. Because look, a stock with a low PE but absolutely zero growth, that can still be incredibly expensive when you factor in opportunity cost. If a business isn't growing at all, a low multiple is usually completely deserved. You always want to pause and ask yourself, if growth slows down, does this multiple actually still make sense?
And this right here brilliantly illustrates why context is just absolutely everything. You cannot use a lazy universal rule like, oh, any PE under 15 is cheap. Sector context matters so much. Banks, IT, commodities, they all have vastly different pure medians. You can't force an industrial framework onto a bank, right? For banks, you really need to be looking at asset quality and capital. And for commodities which are highly cyclical, peak versus trough earnings matter way more than a random snapshot PE. Trying to compare an IT firm's PE to a steel manufacturer's PE is literally like comparing apples to bicycles. It just doesn't work.
Finally, that brings us to the third pillar, balance sheet risk. Even if the earnings are real and the growth looks good, we still have to make sure the company won't actually go bankrupt.
So, can this cheap stock break? By systematically checking these three things, leverage, interest coverage, and promoter pledges, you can figure out if that low PE is actually a genuine bargain or if it's just distressed pricing. High leverage combined with cyclical earnings and a low PE, yeah, that almost always means the market is pricing in serious distress. And please, pay very close attention to rising promoter pledges in those exchange disclosures. If the founders are heavily pledging their own shares for loans, that introduces a super fragile dynamic. it can wipe out equity completely, regardless of how attractive that PE screen looked 5 minutes ago.
Okay, to see how this actually plays out, check out this purely educational comparison. We've got Stock A and Stock B, and they're both trading right near that psychological 100 rupee mark. Now, Stock B has a lower trailing PE of 8 compared to Stock A's 12. If you only look at one basic screen, Stock B looks like the clear winner, right? But let's look a little deeper. Stock B's earnings only spiked from a one-time land sale. Plus, it has high debt and rising promoter pledges. Ouch. Meanwhile, Stock A is mostly cash-backed, has moderate growth, and low debt. The exact same cheap headline price is telling two completely opposite stories here. Fundamentally, Stock A is the significantly safer choice.
So, the huge takeaway here is that we need to completely abandon these common myths right now. Lower PE is not always safer. Sometimes it is a straight-up value trap. A $100 stock is absolutely not cheaper than a $1,000 stock because price per share is never the same as valuation. And one simple screen of a PE ratio is never, ever enough to justify hitting that buy button. But most importantly, any live figures or analyst growth rates you find online, they absolutely must be verified against the actual company filings. Do not blindly rely on unverified data, folks.
All right, so here is your actionable step for today. I want you to build this exact 3-column checklist for your own fundamental analysis. Filter your earnings quality, weigh the growth versus price, and strictly screen the balance sheet risk. You can totally use AI tools or spreadsheet exports to quickly pull the last 5 years of PAT, cash flow, and debt-to-equity data. But remember, AI only speeds up the gathering part. You still have to apply these checks and exercise your own human judgment.
If this explainer helped clarify how to navigate all this fundamental data and actually look beyond the surface of a stock price, go ahead and hit subscribe. Take this checklist, apply it to your own research, and just see how it completely changes the way you view your screens. Oh, and be sure to check out our paired short for a lightning-fast 60-second summary of these exact points so you can keep them fresh in your mind.
I'm going to leave you with this final thought to challenge your next stock screener. When the headline price or that trailing PE ratio looks just way too good to be true, step back and ask yourself exactly what structural, hidden risks are lurking in those annual filings that the rest of the market has already figured out. Happy researching, and we'll see you in the next explainer.